Hey there, I welcome you again in this next chapter of our course on option trading strategies. In the first chapter, we learned about trading options, that is vanilla options, if you have a bullish view or bearish view. Now, from this chapter onwards, we'll talk about strategies which involves multiple legs of option position. So most of the strategies from now onwards would be spread strategies. The spread itself means more than one leg in option trading strategies. Now, the strategy which I'll be talking in this chapter will be used when you have normally a moderately bullish view in the market. Now, what do I mean by moderate bullish view? Moderate means you expect the market to move on the upside, but you don't expect a substantial movement. You're talking about a movement of 0.5% to 1% or something on about 1.5%, not more than that. The aggressive moves sometimes are 3, 4, 5%, but you're talking about small movements in the market. So to capture those kind of movements, you use the strategy of bull call spread. Now, when do you expect moderate bullishness in the market? They are normally under three conditions. The first one being the fundamental perspective. Now, what is the fundamental perspective? See, take for example, if you are tracking the share price of Reliance Industries, and Reliance Industries is about to announce the quarterly results. In the previous year, when quarterly results were announced by Reliance Industries, market went up but eventually corrected back and there was a moderate amount of bullishness. You're expecting similar results from them and a similar move in the market. So to capture that move, you would want to use the strategy of bull call spread. The second perspective would be the technical perspective. Say there has been weakness in the market and the market has been falling on continuous basis, but there's a major support coming in the market. The support could be a moving average support, say like a 200-period moving average, or it could be also a point where the market always falls off and bounces, and then whatever journey it wants to take, it takes from there. So you feel that the market is coming there and there could be a small amount of upside bullishness in the market, and you can capture that move using the strategy of bull call spread. And the third and the important perspective is the quantitative perspective. Now, what is the quantitative perspective? So what happens is this: normally the market trades in the range of +1 sigma to -1 sigma. Now, what are these? These are basically standard deviation from the mean prices, and normally market has a tendency to stay about 70% time within that range. Now the market has been falling and the market is coming to the lower end of that range which we are talking about, and you feel there's a small amount of bounce which is due. So to play that bounce, you can use the strategy of bull call spread. So these are the three scenarios under which you use a bull call spread. Now, what is a bull call spread? So bull call spread, as you can understand from the name, will have call option and it is a two-legged strategy. So what is the first leg in this? Under the strategy, the first leg is that you buy at the money call option. Remember again, you buy at the money call option. And the second leg is you sell out of money call option. Now, how do you know which out of money option should I sell? So basically you take the range over last 10 to 15 days and you'll basically sell the option which is at the end of the range. Say if the range for the market has been say 150 points to 200 points. So you look for that 200 points away strike price and you sell that option. That is a simple rule which is used by a lot of traders when they're implementing the strategy of bull call spread. Couple of assumptions which you have to keep in mind while using the strategy of bull call spread. Both the legs need to have equal number of lots. You can't have 3 lots here, 2 lots there. That is not a proper implementation of the strategy. And both the legs need to have same expiry. These are certain ground rules which are to be kept in mind if you are using the strategy of bull call spread. Now let us understand the strategy more in detail with the help of a demo. Again, I'll be on the website of Opstra. I'll go to the builder here. And I said I have a bullish view and they've already pre-installed the bull call spread. So you click on that and you feel, okay, the market right now, the spot price is about the levels of 19,808. So I would say 19,800 call option I buy. And I feel that over the last 2 weeks, the market has been in the range of 150 points to 200 points on daily basis. So what I do, I write basically about say 20,000 call option is what I write down. And I choose the expiry of coming week, that is the 3rd of August. And I buy this strategy. Now, once it's done, you can see the implementation of the strategy on the chart and there's a payoff chart to it. Now, let us understand the payoff chart. You can see the profit is capped on the upside. The loss is capped on the upside. I wanted to bring this point up right now because whenever you have 2 legs in a strategy, your profits are always capped, even your loss is capped. Now, which is what gives the strategy the flexibility of entering in a bigger position. Imagine if you knew a scenario where you knew that the maximum profit I can make here is say 10 rupees and the maximum loss which I can take is say 7 rupees, and that is fixed or pre-decided, then you know that even if I take 10 lots or 100 lots, my loss is either 70 rupees or 700 rupees depending on how much ever lots I take, and that gives you the encouragement or courage to take bigger size in the market. So bull call spread is used by those traders who have sizable capital or who want to trade multiple lots. You can trade with one lot also, but if you have multiple lots, this strategy makes a lot of sense because you know that my losses are capped, and which is very important, and I know what's the maximum profit I can make. So depending on what my risk appetite is, I can take a trade. Now again, if you focus here, you can see the maximum profit is capped at rupees 5,575 and the maximum loss is capped at 4,425. So these are the maximum points of profit and loss. So it doesn't matter how much the market goes up or come down, you know what have you got yourself into. Now the margin required again is about 20,000 rupees. Why is it lesser? Because you have got both buy position and sell position. In the previous chapter I told you how do you reduce the margin required. You buy a position and then you sell it off, and that is how you reduce the margin required in a particular option. Now what are the points of break-even in this strategy? So break-even point in this strategy is the point of 19,889. Now how do we derive at this point? So basically what you do here is this, that whatever amount of premium which you have overall paid, basically because you have bought at the money and sold out of money, there'll be outflow initially. So whatever amount of outflow or whatever units of outflow you have, you add that to add the money strike price, and you get the break-even point, that is 19,889, as you can see here from the screen. So that is a simple strategy implementation of bull call spread when you have a moderately bullish view. If you are very aggressively bullish, you could still apply this strategy because you know that your profit can be seen and your loss can be seen, but there are better strategies which are suited when you expect a bigger move in the market. So that is it from in this chapter. We learned the strategy of bull call spread, which should be used when you have a moderately bullish view. In the third chapter, I'll talk about another strategy which can be used when you have a moderately bullish view, and that strategy is called as the bull put spread. So let us brace for the ride, and I'll see you in the next chapter.